You open the email, and there it is, the acceptance letter from your dream university. The excitement is overwhelming until you scroll down and see the tuition fees. Suddenly, that dream feels a million miles away. How are you supposed to afford this?
It's a moment of panic that millions of students face every year. The cost of education is high, but the right funding can turn that dream back into a reality. The problem is, the loan application process can feel like a maze designed to confuse you. Don't worry. In this video, we're going to give you the map. We'll walk you through every single step of applying for an education loan in 2026, from understanding the basics to signing the final papers. By the end, you'll have the confidence to secure the funding you need. First, let's get our bearings. What are we actually talking about? There are two main types of education loans: federal and private. Federal loans are funded by the government and are almost always your best first option. Private loans are offered by banks, credit unions, and online lenders. Before you apply for anything, you need to gather your toolkit. This is your document checklist. You'll need your social security number, your parents' financial information if you're a dependent, your federal income tax returns, and bank statements. Most importantly, you'll need your university acceptance letter and a document outlining the cost of attendance. The cost of attendance, or COA, is a key number provided by your university's financial aid office. It's not just tuition. It's an estimate of your total expenses for one academic year, including tuition, fees, housing, food, books, and transportation. This number determines the maximum amount you can borrow. Now for our first and most critical step. Before you even think about private loans, you must complete the FAFSA. That's the free application for federal student aid. This single form is your gateway to all federal financial aid, including grants, work study, and those valuable federal loans. Why is this so important? Federal loans typically have fixed interest rates, more flexible repayment options, and don't require a credit check for most undergraduate loans. Skipping the FAFSA is like turning down free money and better loan terms. Always start here. After submitting the FAFSA, your university will send you a financial aid award letter. This is where you see what help you're getting. It will list any grants or scholarships, which is free money you don't pay back, and the federal loans you qualify for. Now, it's time for some simple math. Let's say Maya's cost of attendance is $50,000 for the year. Her award letter gives her a $10,000 grant and offers her $5,500 in federal loans. That's $15,500 in aid. The remaining amount, $34,500, is her funding gap. This is the amount she might need to cover with a private loan. With our funding gap identified, we move to step 2, researching private lenders. This is where you need to be a smart shopper. You're looking for a loan to cover that $34,500 gap. Don't just go with the first bank you see. Create a comparison chart. You need to compare 3 key things: interest rates, repayment terms, and fees. For interest rates, look at whether they are fixed or variable. A fixed rate stays the same for the life of the loan, while a variable rate can change over time. Fixed is usually safer. Repayment terms refer to how long you have to pay back the loan, typically 5, 10, or 15 years. A shorter term means higher monthly payments, but less interest paid overall. A longer term means lower monthly payments, but you'll pay much more in interest over time. Finally, watch out for fees. Some lenders charge an origination fee, which is a percentage of the loan amount deducted from your funds before you even get them. A 3% origination fee on Maya's $34,500 loan means over $1,000 is gone from the start. Look for lenders with 0 fees. Most students will need a cosigner to get a private loan. A cosigner is a credit-worthy adult, usually a parent, who agrees to be legally responsible for the loan if you can't make payments. Their good credit score is what helps you get approved and secure a lower interest rate. Let's say Maya's dad, David, has a credit score of 780. This tells the lender he is a reliable borrower. Because David is co-signing, the lender might offer Maya an interest rate of 6.5%. Without him, she might be rejected or offered a much higher rate, like 11%, which would cost thousands more over time. Step 3. Complete the application. Once you've chosen a lender, it's time to apply. This is usually done online. You'll fill in your personal information, details about your university and major, the loan amount you need, and your cosigner's information.
This is where you'll upload the documents from your checklist: proof of identity, proof of income for your cosigner, and your school's cost of attendance sheet. Be thorough and double-check everything for typos. A simple mistake can cause delays. After you submit, the application goes into underwriting. This is the behind-the-scenes process where the lender verifies all your information and assesses the risk. They'll run a hard credit check on your cosigner, which will temporarily dip their score by a few points. Step 4. Review and accept your loan offer. If approved, you'll receive a loan disclosure statement. This is a critical document. It outlines the final terms, the exact loan amount, the interest rate, APR, the monthly payment, and the total cost of the loan over its lifetime. Read every single line. Let's look at Maya's offer. A $34,500 loan at 6.5% APR for 10 years. Her monthly payment will be about $392. The total amount she'll pay back is over $47,000. Seeing that total cost is sobering, but it's crucial for understanding the long-term commitment you're making. If you're comfortable with the terms, you and your cosigner will electronically sign the loan agreement. Congratulations, you've secured your funding. But we're not quite done yet. Step 5. School certification. The lender doesn't just hand you the money. They send the loan details to your university's financial aid office. The school confirms that you are enrolled and that the loan amount doesn't exceed your cost of attendance minus other aid received. This process can take a few weeks. Once certified, the final step is disbursement. The lender sends the funds directly to your university to cover tuition and fees. This usually happens around the start of the semester. If there's any money left over after the school's charges are paid, they will send you a refund check. This can be used for books, supplies, or living expenses. And that's the process from start to finish. Now let's talk about a few common mistakes to avoid. First and foremost, borrowing more than you absolutely need. Just because you're approved for the full cost of attendance doesn't mean you should take it. Remember, every dollar you borrow is a dollar you have to pay back with interest. Mistake number 2, not understanding your repayment. Most student loans have a grace period, typically 6 months after you graduate or leave school, before you have to start making payments. Know this date. Mark it on your calendar. Missing your first payment is a terrible way to start. Mistake number 3, ignoring cosigner release options. Some private lenders offer to release your cosigner from the loan after you've made a certain number of on-time payments, typically 24 to 48 after graduation. This is a fantastic feature that protects your cosigner's credit in the long run. Ask about it before you sign. What if your application is rejected? Don't panic. First, ask the lender why. It's often due to the cosigner's credit score or debt-to-income ratio. You can try to find a different cosigner, or your current cosigner could work on improving their credit before you reapply. You can also simply apply with a different, less strict lender. So let's do a quick recap. Step 1, complete the FAFSA to access federal aid. Step 2, calculate your funding gap and research private lenders. Step 3, complete the application with a credit-worthy cosigner. Step 4, carefully review and accept the loan offer. And Step 5, wait for school certification and disbursement. Securing an education loan is a major financial decision, but it's also an investment in your future. By being organized, doing your research, and understanding the terms, you can navigate this process successfully and turn that dream of higher education into a well-planned reality. If this guide helped you feel more prepared to tackle your education funding, please give this video a thumbs up. And for more step-by-step guides on life's complex tasks, make sure you subscribe to Shad How To. We're here to help you figure it out.